All right, jobs slowing a little bit in the month of December. The unemployment still at a close to two-decade low. Stocks are continuing record runs with this sort of interpreted sort of like a Goldilocks report, kind of perfect as she goes. Market watchers Kathryn, Rooney, Vera, and Brian Wesbury here. Brian, that was kind of like the knee-jerk read of it. It wasn't robust, but it wasn't awful either. Continues a pattern of slow and steady growth that I guess a lot of folks hope will pick up steam. But what do you think?
Yeah, well, look, 148,000, these jobs reports, they could be 100,000 either way. So I look at this as right in line with what we've experienced over the last bunch of years. There is no reason to believe this economy is slowing down at all. In fact, it's accelerating right now. The tax cut this year is going to make it accelerate even more. Regulatory reductions accelerate even more. Earnings are up. The corporate tax rate being lower is great for corporate earnings. This is 1 month's report. Yeah. I'm not going to read it into the macro environment in any big way. All right.
Kathryn, I wonder, the Wall Street Journal kind of took the president to task for constantly talking about the markets. Who can blame him? They have been running up. He talked about down 25,000 yesterday, but they could easily turn, and the media is going to pounce on him for that. But he has constantly referred to that. Do you think there is a danger in doing that?
Oh, come on, Neil. Absolutely. I mean, the president, if he's going to own the upside, he's got to own the downside, too. So absolutely, if we see a correction, then the president is not going to be tweeting about it, but he's going to have to own the upside and the downside. I actually agree with Brian. I think that there's a lot of good news in the pipeline, and this non-farm payrolls number does not change either the market's trend or the economic trend. However, I will say one thing. Watch real wages. Watch wage growth. It was still stagnant at 2.5% year over year in this morning's release. If we see an acceleration, that will and can precipitate an acceleration in core PCE, which is the metric that the Fed most closely looks at.
Yeah, if I'm on the Federal Reserve, Brian, I'm looking at this saying, well, we have no reason to go crazy here and start hiking like nuts because I guess the expectation is for 2 more hikes this year, could be 3, but I see little in the way of that. What do you think?
I totally agree. I mean, we actually think we're going to get 3 rate hikes this year, Neil, and possibly 4. And I'm right with Kathryn. Inflation, there is a chance. Well, in fact, inflation is picking up a little bit. There's a chance it'll accelerate more. We have to remember there's still $2 trillion of excess reserves in the banking system, and that's fuel to the inflation fire. But
what does that mean when you say fuel to the inflation fire? The $2 trillion. How? Explain.
Right. Well, reserves in the banking system. This is money that the Federal Reserve puts in. That's what can turn into loans and more M2 growth and more money growth, and that's what causes inflation.
And we're not seeing a heck of a lot of that.
Inflation is a monetary phenomenon. No, we're not.
Okay.
However, it looks like things are picking up a little bit, and that means we're going to have higher interest rates. But I'm not worried. Rates are too low today. They're still excessively low, and a little bit higher rates aren't going to stop this bull market.
Yeah, normally bull markets keep thriving as rates are going up. Now, Kathryn, play out this year. We had a market expert on who accurately predicted Dow 25,000 a year ago, talking up Dow 30,000 this year. What do you think of that?
Look, I think that there is certainly some upside. There are definitely some risks. We cannot discard them. Those are inflation. Those are the administration exiting both NAFTA and WTO, that they are North Korea. Those are the principal risks. However, I am bullish. I think that the S&P, for example, goes to 3,000 this year. That's based on earnings growth. Multiples look extended, and we can't negate that. However, compared to earnings growth, they don't. And if, in fact, earnings grow to our approximate number, which is 140 versus 119 currently, then we do think that earnings growth will validate current multiples, and we can get the S&P moving to 3,000 by the end of this year.
So it's not a rich market to you. At these levels, given all that, it's not a rich market, even with this run-up.
If we get earnings growth continuing at a double-digit pace, which is consistent with the tax reform. I think it's all banking on that. We will get higher markets this year.
All right, we'll see. Guys, I want to thank you very, very much. Well, Republicans certainly are hoping to see that happen.